Let's kick things off with all the market action today. Bob Iaccino is Path Trading Partners co-founder and chief market strategist. Bob, it's good to talk to you on this Friday. Let's start with those tech trades, certainly back in the driver's seat after all the talk about potential rotation out of the sector. I'm looking at the numbers here. Amazon and Alphabet up over 4%. We talked about Apple seeing 7% gains this week. Then, of course, we've seen Tesla up 25% this week alone. How do you explain all of this?
Well, it reminds me of the tech bubble, quite frankly. And I mean, I'm not calling this the new tech bubble, but it certainly could be. I don't want to be the person to call it that because I started calling the 2000 tech bubble. I was around. I know I look great, but I started calling the 2000 tech bubble a tech bubble in like 1997. So you can be very early on those kinds of things. The funny thing to me about Tesla is when do you see a company double its market cap basically in 3 weeks, which is essentially what happened with Tesla. It's not a stock that we look at on a day-to-day basis or even a month-to-month basis. You're talking about the NASDAQ 100 having 102 stocks in it. 96 of those stocks are worth the exact same as the top 8. So it's a little bit of a struggle to get behind this market, except when it's broadening. So I prefer when it's broadening. I don't think the NASDAQ needs to go negative while the other 3 go positive, but I really like the days a lot better when the Russell is leading and the NASDAQ's up maybe 25 basis points as opposed to the NASDAQ being up 1 and the rest being flat.
When you talk about the kind of gains we've seen in Apple and Tesla, is it really all about the stock split? And if so, you think other companies are looking at this saying, well, maybe we should start considering it?
Well, I hope not, because you have to have sort of a cult following for the stock split to have that effect. Historically, and I'm going to take the last 10 years out, historically, stock splits are not necessarily a bullish thing. It's actually about 60-40 bearish to bullish. Splits now seem to be happening to just make the stock more affordable for retail. That really seems to be what's behind it. Certainly seems to be what's behind it for Tesla. I'm not sure I understand the stock split for Apple, given where the price of the stock is, but it does make sense and it makes it more appealing to retail. People seem to think that the price of the stock is important, whether they're playing options against it because you need that round 100 lots to do that, or whether they're just buying it and they're just used to a certain amount of shares. We tell people all the time, you can buy 1 share of a stock. You can even buy fractional shares on certain platforms. So the price shouldn't matter. It's the momentum of the stock if you're a momentum investor, and it's the value of the stock if you invest in companies that actually make money.
We've seen the S&P 500 and the NASDAQ hit new records this week. You said you've started exiting some positions as you've seen the market push even higher. What are you rotating out of and where are you finding the opportunities?
Well, we like commodities short term, believe it or not, even though I'm short crude oil right now. The reason I say that is because, well, let me go back to why we're exiting things. When I look at the entire bear market essentially being over, and I'm considering it to be that the case with the S&P and the NASDAQ both now essentially at new all-time highs. So the bear market essentially is over. I'd love to see the Dow and Russell there, but they're not. Now I start to look at the economic backdrop and the potential for earnings. And are they better than they were pre-pandemic or are they worse? I believe that they're worse. And now that the prices are equal for the 2 time frames, it seems to me to be a good time to maybe at least get some sideways movement, if not a bit of a sell-off. So we're exiting a lot of things. We're not exiting everything. We're staying in things that we have big gains in, and we're getting out of things that we made fast gains in, if that makes sense.
So you're getting out of growth.
Correct. We're getting out of growth and momentum. We're hanging on to things like Kraft Heinz. We're hanging on to things like Anheuser-Busch that we own. We're hanging on to Lulu. We're hanging on to Starbucks. We're hanging on to things that if the economy turns, those things will benefit. If they don't, they'll fall in a little bit more stomachable manner, if that makes sense.
Bob, you said you're looking at the economic recovery and seeing how the picture shapes up right now. On that front, we're seeing oil down today, largely because of concerns about sluggish demand. I mean, how are you seeing that on a global level here? We've sort of seen this stop and go in terms of reopening here in the US, but it doesn't seem like things have dramatically improved globally as well in terms of oil demand.
Well, here's what I like about commodities in general and oil specifically. Oil is always a supply and demand equation, and that's it. There are exogenous shocks to both things, both supply and demand. Demand, we had the pandemic. Supply, we had the attack on the Saudi facility some time ago. But it is essentially always a supply and demand market. And what we've seen over the last, let's say, month and a half, 2 months, is a sideways, slightly up market. That slightly up was because the thought was that demand was going to slowly build as we reopened. And now that reopening, best case scenario, has stalled. Worst case scenario has reversed. So it's really dependent on the pandemic. OPEC has said that they're going to pump more, but they haven't yet. Russia has, though. And OPEC and Saudi Arabia have no control over Russia. So it seems to me that there's a little bit of an imbalance now. But this is what crude oil does. If you look at a crude oil chart, it goes sideways until there's an exogenous shock to either supply and demand. We don't have either right now, but I think it's more likely that demand weakens and supply slowly increases.
So given how Russia has acted, how do you think OPEC moves now?
I think it's a rhetoric game for OPEC when it comes to Russia, because they can't really do anything to Russia. They can actually do things to the other members of OPEC. So when you're talking about OPEC Plus coming to an agreement, that agreement ended at the end of July. They discussed more. They've got a meeting coming up. It's likely they address it in the meeting. But Russia, number one, you have to get them to agree. And then number one, you have to get them to comply. They don't have any sort of path to get Russia to comply.
Okay, we'll continue to watch that dynamic. Bob, good to talk to you on this Friday. Bob Iaccino, Path Trading Partners co-founder and chief market strategist there.